As a GEPF member, are you worried that you might lose money when the new two-pot system comes into effect? Now, what if I told you there might be even more for you to stress about than what you initially thought? That's right. The GEPF is not stopping at two pots. They're rolling out a three-pot system. No, this isn't a rumor. It's a reality, and it's coming sooner than you think. Now, you might be wondering, what does this mean to you? How does this affect your hard-earned money? Don't worry, I've got you covered. I'm Devanaiker, a certified financial planner and Retire/Resign specialist. In this video, I'm doing a deep dive into the official GEPF proposal, dissecting every crucial detail so you don't have to. Now, don't go anywhere because your financial future might very well hinge on the crucial information you're about to receive in the next few minutes. And trust me, you'll want to stick it on until the end because I'll reveal a secret that could help you determine whether you've lost money from the two-pot system or not. This is insider knowledge, so you don't want to miss it. Now, within GEPF, there's always a lot of rumors. So to ensure that you're getting the clarity that you need, I'm going through the official document that was produced by GEPF. So you can see here, it's with their logo. And I want you to be mindful, the first section of this document talks about the two-pot system in general, as it applies to a private sector. Later on in the document, it goes into details on how GEPF is applying this. Keeping in mind, GEPF is a defined benefit fund, meaning it operates on a set of formulas. But again, I'll explain everything as I head over between the iPad, and I'll be referring to this document as I go along. So I'm skipping through these sections here. Now, you want to understand in general how the two-pot system works first, and then we're going to add in the layers that GEPF puts on top of it, right? So let's get started. What it says here, all contributions from 1st of March 2024 will be divided into two pots. 1/3 of the contributions will go towards a saving pot, and members will be able to access this one taxable withdrawal per year. Let's go into the iPad so that you get an understanding as to what's happening, right? Now, remember, again, this is on the private sector. So I'm doing this one for the private sector, and we'll add later on GEPF. So what it's saying here is, here's your savings pot. This is one of the pots that we put into place. Just for the purpose of maths, I'm going to use an example here so that you understand how this is calculated, right? Let's use an easy example. Instead of 900, I'm going to use a figure of 300 Rand, right? So imagine your contribution is 300 Rand. What's happening is 1/3 of this is heading into your savings pot, and 1/3 of that is 100 Rand. Now, I'm making this extremely easy because I want you to understand the concept, and then it gets a bit complicated when we get into how GEPF is implementing it. So heading back into the document, we've dealt with the savings pot. Now we've got 2/3 that will be paid into a retirement pot, which has to be preserved until retirement and used to purchase an annuity. So for now, don't worry about annuity. It's just a fancy word for income. But let's go draw the retirement pot so that you have an understanding again of how that particular pot works. So we said 1/3 of your amount will go into a savings. Then we've got another pot here, which heads into the retirement. And this is the 2/3 element, right? So this is 200 Rand. Now I want you to observe what I've just done. There's two portions. Your monthly contribution, let's using this example, is 300 Rand, right? So that's what's getting into the fund. What's happening from the 1st of March is you'll end up with a savings portion. This is 100 Rand here, 1/3, and then the retirement portion, which is 200 Rand. Now this pool here, the savings portion, this is what can be accessed. I'll go into the details and all the tax consequences just now, but you can access this, and provided you have a minimum value here of 2,000 Rand. So the moment you have 2,000 Rand, you can start to access money inside that. Remember, it's also 1 time per year. So 1 time that you can access this per year. Again, I'm reminding you, we are dealing with the private sector so far, right? Okay, moving on from here. It talks about multiple funds. I'm going to skip that. Then it speaks about accumulated funds, right? So what happens to money that you've accumulated? So the balance that you've accumulated in the retirement fund up until 29th of Feb 2024 will be kept in a separate pot, which is a vested pot. So there's money up until 2024. So let's head over onto the iPad so that you have an understanding of what I'm doing here. I want you to follow along with me, right? There's a portion of money. This is 1st of March 2024. This is when it actually takes effect, right? But money that you have before this, it's going to be housed in what is called a vested pot. And money that you have after this is going to be housed into the two pots that we've just looked at now. one being the retirement pot, and the other being a savings pot. So I hope the visuals give you a good understanding of this. But again, for now, the figures are not important, okay? I just want you to understand the concepts. And again, I'm going to be bringing in how GEPF is tackling with this just now. So heading back onto the system, it says the same rules will apply that apply currently to that vested pot will continue to apply, right? Then it's going on further to say how much of your current retirement value you can access on the 1st of March 2024. Now, technically, it should be zero, right? Because if you have a look at what I've drawn for you here, on the 1st of March 2024, you have whatever contributions you had before March that's sitting inside a vested pot. Then your savings pot on the 1st of March 2024 will actually be zero because you still to contribute money into the fund. But this is where they talk about seeded capital. So let's go understand it. And again, I'm going to draw it for you, right? So it says Treasury's legislation allows you to make a one-time withdrawal when your balance reaches 2,000 Rand. However, it's going to take time for that value to grow. So recognizing this, you see Treasury is allowing you to do what is called seed capital, meaning you can take money from your vested pot and move 10% over, but again, it's subject to this maximum of 25,000. I'm going to illustrate it for you, so don't be concerned. Just follow along in the example so that you understand it. Again, it gets a bit more complicated when we tackle the GEPF part. So just want you to pay attention to this, and then we'll add in more layers afterwards. Here's what's happening. I'm using an example. Let's say inside of the vested pot, you have 300,000. I'm making the math look very easy today because, again, I want you to understand the concepts. So if you had 300,000 here, now you can do what is called seeded capital, right? Seeded capital. And the seeded capital is a maximum of 10% or 25,000. So notice here, 10% of this vested pool is 30,000. We cannot move that. On the 1st of March, you can move over 25,000 into this pool. Now, if you have a smaller capital, then yes, it's going to be a smaller amount. But again, I'm helping you to understand just the concepts, which means come the 1st of March, you will be able to access some of this money because of how this is structured. Right? Let's head back there so that you understand this. Right? How will your contributions? This is just giving you the example, which I'm going to skip through because I've done that for you already. Right? Then, will the withdrawals from the savings pot be taxed? Now, understand this part very carefully because it's critically important. And again, I'll add in more layers just now. Any withdrawal from the savings pot will be added to your taxable income and taxed at your marginal tax rate. So let me explain this because it's critically important for you to understand it. Notice again, I'm reminding you constantly, we still haven't yet tackled GEPF side. I'm going to tackle that one just now. So how our system is structured is the more you earn, the more tax you pay. What's going to happen if you access money from the vested pot or from the savings pot that's here is the following. You can access, remember, up to 25,000. So I'm going to use 25,000 in my example. So they're going to take your salary. SARS is going to take the salary plus the amount that you've taken out from your savings pot. Let's use an example. Assume that your salary is 25,000 for the month times 12 months. This is 300,000 for the year. So normally you'll be taxed on 300,000. However, when this two-pot system comes in effect, if you are going to take out 25,000 here, now your total tax is going to be on 325,000. This could be a problem because now you could possibly move up a tax bracket. So you want to be extremely mindful. Now, the plot thickens when we bring GEPF in, right? So make sure you understand what I'm sharing with you now as the foundation. Just now I'm heading over onto the GEPF side so you can understand how GEPF puts this one into practice, right? Now, actually, here it goes. Are government employees included in the two-part system? Definitely, right? All defined benefit funds, including GEPF, is part of the new two-part system, right? But because defined benefit funds operate according to formulas, notice what is being said here. The way in which the different pools will be calculated differ to how this is done in the private sector. So how will this work for GEPF? Let's go into more details. It says that the fund would calculate 1/3 contributions to the savings component with reference to 1/3 of your pensionable service. So let's head back there so you understand what is happening. Inside of this, you still have the three pots that I've shared with you now, right? A vested pot, a savings pot, and a retirement pot. However, the amount of money that's sitting inside each of the pot is based on your years of service that you've had. It's not a straightforward calculation like what I've done for you now. If you notice what I've done here, in the beginning, I mentioned to you a 300 Rand contribution is split two ways. 100 Rand going here, 200 Rand here. It's not going to operate in that way with GEPF because GEPF is a defined benefit fund. Everything is going to operate in terms of formulas. Let's head back onto the document. We read a bit more, and then I'll come back to give you more information. The 2/3 contributions to the retirement component with reference, see, is also calculated based on 2/3 of your pensionable service. So again, I want you to see everything is happening based on your pensionable years of service. Now, very important, and this is why they've got it in bold. Important for you to remember that your GEPF benefits are calculated based on your salary as well as the service, right? So both of those, when GEPF is determining the formula, the higher your salary, the higher your benefits. The longer your years of service, the higher your benefits. So that's the framework I want you to keep in mind. Now, next up, it says the vested part will be based on pensionable service up to 29th of February 2024. The vested part will not be a fixed amount. I'm going to say it again. The vested part will not be a fixed amount because as we've just been saying now, even if you had 10 years service, they're using an example here. Remember, it's calculated based on your final salary. Your final salary as well as your years of membership. Let's head back onto the iPad so that you understand this component quickly, right? Okay, now I'm going to draw an example here because I want it to make sense to you. Just follow along on the system. Let's use an example to say that you started work here. And let's say the two-part system is taking effect 1 March 2024. Let's just say in my example that you actually started work 10 years earlier. So you've started work 10 years before. Now all your benefits are preserved inside there, and that's what's sitting inside what we've called now the vested part. That's what's sitting inside. If you are there for 20 years, then it's 20 years. If you are there for 30 years, all of this forms part of the two-part system. So whatever happened here before then stays as part of the vested pool. How are the amounts calculated? It's calculated again based on your salary, but it's your salary and years of service to when you actually exit. This is important. You might still continue to work for government for a few more years. So let's say you're working for another 10 years or 20 years or 30 years. Beyond this, what's going to happen is they're going to look at your total years of service in the end, and they're going to split this money up. So you'll have a portion that sits here before the two-part system came in effect, and you'll have a portion that sits here, again, based on your total years of service. Let me make this easy for you, and I'm going to use an example, right? Now, you'll follow along, and you'll do the same using yourself, right? Towards the end, I'm going to do a calculation for you. I'm going to give you some homework to do, right, in order for you to understand the true impact of this. So let's say you're vested, you've been working for 20 years, and assume that you're still going to work for another 10 years, right? Beyond this, which means the total number of years of service is 30. So when the formula is being calculated on what's sitting inside here, 20 out of 30 years is what will be in your vested part. And 10 out of 30 years is what will be in the remaining parts. And it'll be calculated based on your salary here. So I hope it makes sense. If it doesn't make sense, please watch this video again so that you have an understanding. Let's go back in because there's a few more important areas I want you to be mindful of. Now it goes on to talk about seeded capital. So remember, as I shared with you before, you can move over 10% of money that you've had before 1st of March into this pool, but nothing more than 25,000 can be moved over. Very important, so pay careful attention to this one. It asks the question, can I access money on a regular basis? Now members will be able to withdraw money from their savings pot without the need to exit. So you can access money from your savings pot, provided you have at least 2,000 Rand inside of that savings pot. Next, withdrawals will be limited to 1 time in a year. So you can only access this 1 time in a year. All withdrawals, this is vitally important, all withdrawals done will result in a reduction of your pensionable service recognized for the savings pot. Now, this is crucial for you to understand. In fact, for every single GEPF member to understand, because your benefits are tied in to those two factors. So remember, it's your salary. The formula also takes into account your years of service, right? These two factors actually determine how much of money you have sitting within GEPF, right? They determine what's sitting inside your pool. This could be your retirement benefits. It could be your resignation benefits, right? But they determine either of those benefits. Now, what is being said here is if you are going to access some money from the savings pool, so see here, if you're going to access some money from the savings pool, in essence, what's happening for that particular pool is GEPF is going to reduce your number of years of service. When they adjust your number of years of service, you might have taken 25,000, but at the time that you actually end up leaving, because they're reducing your years of service, not the rand value that you've taken, you might find out that the amount of money that's short could be way more than 25,000. Let me say this one again. So let's assume on the 1st of March, you access some money, 25,000, but you're only leaving here 10 years later or 5 years or even a year later. Now, your salary would have increased, chances are, as well as your years of service would have increased. So your benefits would have increased. But when they are calculating what's sitting inside your savings benefit, they're calculating based on the new salary, which means when they're working out how much is going to be less, it could effect be much more than 25,000. Now, again, I hope it makes sense. If it doesn't, please watch the video again so you can understand it, right? Because remember, GEPF is a defined benefit fund. It always operates according to a set of rules. Just like what we shared earlier, the withdrawals will be added into your current salary and you're going to be taxed accordingly to that, right? Critically important. Next step. What happens if you are resigning? Will you be able to access your money? Now, I'm going to go through this one very, very slowly. Please make sure that you understand this, right? So if you're looking at resigning because you want to take control of your money, it's important for you to understand what's happening going forward. I do have some gray areas here. There's a lot of question marks with how the resignation is taking place. But again, we'll have a lot more clarity from GEPF when more information is being produced. But what they are saying is, upon resignation, a member is currently, so before the two-part system, entitled to their full actuarial interest. So right now, if you are to resign, you can access your full actuarial interest. What's the full actuarial interest? Simple. It's the sum of your vested pot, the savings pot, and the retirement pot. So let's head over so that you understand what's taking place, right? I'm going to do a before and after for you of the two-part system. So we get to see, right? This is now, here's 1 March. Let's get that written down better. This is 1 March 24. So you can see what's happening before and what's going to happen after. So before the system comes in effect, right? You know that you have a resignation benefit. And the resignation benefit is equal to, currently, it's your vested pot. You just can't see this, right? Because the two-part system is not into play as yet. But it's the vested or the three-part system. But vested pot, your savings pot, plus retirement pot. So if you are going to resign, you can gain access to all of this. Now let's use an example. Again, I'm going to use a figure to make the math look easy, right? Let's say that total is 3 million. So if you are leaving before 1st of March 2024, you're able to access this, and this figure comes to, let's say in my example, 3 million, right? When you get your benefit statement, you'll be able to see exactly how much is in there. It's that resignation value. So notice that's the first step that's in here, 3 million rand. What's taking place post? Let's go back onto the document so that we can analyze it together. You'd see under the two-part system, when you resign, you'll be entitled to an immediate benefit equal to the vested pot and the savings pot balances. The retirement pot may not be paid immediately on resignation. This benefit will be preserved and only accessible at retirement or death. So let's go back to understand this. Again, the before and after what's taking place here, right? What they're saying is post two-part system, once it comes in effect, you can still access your vested pot plus savings. That's what you can access. It's what you can gain access to, right? Not retirement. So you'll not be able to access the retirement part. The retirement part is going to be kept until you get to your retirement age or until you close your eyes, you pass away, right? Now, there's a lot of gray areas. What are the gray areas? One, retirement age for your sector could be 60 or 65, right? If you are within SAPS, retirement age is at 60. If you are Department of Health, Department of Education, retirement age is 65. So the question is, can you access this money at 60 or 65? Then in South Africa, early retirement is 55. So could you access this money at 55? You have to wait until the end. So this is where I said there's a lot of gray areas around this. Going on a bit further, this is the alarming part for me. Resignation benefits will be taxed at the withdrawal tax tables. So resignation benefits will be taxed at the withdrawal tax tables. What does it mean? So let's go on to a tax guide. Remember, when you're doing this, always ensure that you're working with the latest tax guide from SARS. So I've got here a budget tax guide 2023. You can see it from SARS. You can download this for free. Now, there are two tax tables. There are two tax tables. The one that I talk about often inside of the videos is this one, which is a retirement fund lump sum benefit table. You'll notice here, it's 550,000, that's tax-free. Used to be 500,000, it's received a bump up, right? So 550,000. However, according to GEPF, they're not taxing based on this table. They're taxing on a withdrawal tax table. I'm highlighting the word here. See, retirement fund lump sum, withdrawal benefits. And when you look at this, the tax-free portion is only 27,500. So, which means if you are aiming at resigning, now the tax penalty is going to be a lot higher than before the two-part system comes into effect. Now, there are a lot of gray areas within this, and we'll get a lot more clarity once the system comes into effect, and obviously once GEPF provides more information. But from what is being shared right now, these are the things that are a bit alarming for members. What can you do to protect yourself? An easy exercise, which I'm going to walk you through right now. So if you are aiming at leaving at 2024, so let's say you are leaving sometime in 2024, one step that you can start to analyze is you want to make a decision on whether you must leave before the two-part system takes effect or after. There's ways to do the calculation. I'm helping a number of members with this, but you want to just weigh that up, right? Especially if you're leaving in 2024, because this is when the whole system comes into effect. If you're not leaving in 2024, if you are leaving at a later stage beyond that, then you sort of have to go with the flow into the system, right? So then in that case, you want to do the exercise that I'm going to share with you now. The exercise is simple. Because GEPF is a defined benefit fund, it's a defined benefit fund, then you can make a request for your benefits to be calculated at a certain time. So for example, you can request a statement from GEPF. You can do this now. You can request a statement as at, I'm going to use an example, June 2024. This is post two-part, right? So June 2024 is post two-part. So you're going to request a statement now, see, before two-part. See, you'll get a statement and you want to see what's your resignation value. Now, this is not saying that you're going to resign, right? Not at all. But this gives you an idea to see what's your resignation value before the two-part system. You also want to see what's your retirement figures before the two-part system. You got to compare both values, right? So you're getting a statement from GEPF now, and you are asking them for the statement to be calculated and your benefits as at the 30th of June 2024. Then on the 1st of March, the new system comes into effect, 1st of March 2024. So what you want to do at that stage is you now reach out to GEPF again and tell them you want to have another statement, and that statement must be as at the 30th of June 2024. So if you look at what's happening here, you should end up with two statements dated 30th of June 2024. One statement that you asked GEPF before the two-part system, one statement that you got from GEPF after the two-part system. And then you're simply going to compare values. You're going to look at your resignation value, has it increased or decreased? You're going to look at your retirement value, has it increased or decreased? And you want to watch this very, very closely, because sometimes there's certain amounts that might be missing, right? You might not notice it. For example, let's say your benefits were reduced by 100 Rand. So your resignation was reduced by 100 Rand, or your retirement benefits reduced by 100 Rand. Now you might not be able to see this, right? Because it's a small value. However, when you start to look at the size of GEPF, right, you've got to bear in mind that there's 1.2 million members working for GEPF, right? So approximately 1.2 million. When we do the math on that, right, this 100 Rand, if GEPF reduces benefits by 100 Rand, that equates to 120 million Rand that's sitting inside the GEPF kitty. Okay. So for this reason, you want to make sure that you're having your calculation done, just so that you get to see that the benefits before two-part system and the benefits after the two-part system, you're still in an advantageous position. I hope you found the video has been helpful. I know it's been a long one. Please ensure that you watch this video again so that you understand the concepts. And very importantly, make sure that you do the exercise for yourself, especially if you're not leaving in 2024. If you are leaving in 2024 and you're needing some assistance and you've got more than 25 years of service, you're welcome to send an email to reach out to me for a private consult, and I'll go into more details into how you can protect your capital, right? And also, very importantly, whether it's beneficial for you to exit before the two-part system or after the two-part system. I'll see you in the next video.